Hey, what's up, my friend? Welcome back to the sixth episode of AskRayner, and today's question is from Mark, right? Hello, Mark, right? Who asked me, right? Hey, Rayner, how do you find the best risk to reward trading setup, right? So I'm going to share with you my own opinion of, what the risk to reward equation is all about and how to go about, finding such trading setups, right? So all this and more in today's episode. I'll see you there. Okay, so welcome back to the sixth episode of AskRayner, and in today's episode is a question from Mark who asks, right, how do you, find the best risk to reward trading setups? Before I can talk about it, right, I need to, let you know, some of the myth, right, behind risk to reward, right? I'm sure you have encountered, stuff like, we should always aim for a minimum of a 1 to 2, a 1 to 3 risk to reward, right? Risking $1 to make $2, risking $1 to make $3, etc. But this isn't a complete picture, right? The risk to reward equation itself is not a complete picture. Why is that? Because you can have a 1 to 2 risk to reward, that is possible, but if you only have a win rate of, let's say, 20%, in the long run, you're still going to lose money with a 1 to 2 risk to reward, right? I can share this with you, I can prove it to you, right? Let's say you have 10 trades, right? Let's say 8 losing trades, 5, 6, 7, 8, and 2 winning trades. Right, 20% win rate. So say each time you lose is a dollar minus one, 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 minus one. Each time you win $2, right? Because you win 2 times your initial risk, so it's $2. So you can see that in total, you add all your losers and winners together, you are going to be down a total of $4. Right? You're losing money with a 1 to 2 risk to reward. Why is that? Because your winning rate, this winning rate over here, is insufficient. Right? So this is why I say that your risk to reward isn't a complete picture. What you need is both your risk to reward and the probability of the event occurring, otherwise known as your winning rate. Right? These two combined will give you the complete picture, whether you have a positive expectancy in the market. Okay, so this is the first myth, right? Risk to reward isn't a complete picture. Don't get fixated on looking for a minimum of a 1 to 2, 1 to 3, 1 to 5. Because, why not say I look for a 1 to 1,000 risk to reward, right? I risk $1 to make $1,000, right? That is possible, right? Why not aim for the stars? But the thing is, your probability of it occurring is low, right? So this is why risk to reward itself is not a complete picture. Moving on, right? Not all trading strategies rely on this risk to reward concept. I think most strategies would rely on it, but there are certain strategies that totally don't even look at it, right? And one such strategy is trend following, right? Why do I say that? Because if you know about trend following, you know that trend followers, we do not have a fixed target. We do not say, for example, take our profits at the highs or the lows and stuff like that. We only trail our stop loss, right, as the market moves in our favor. This means we have no idea ahead of time how much we are going to win or how much we are going to lose, because we do not have a fixed target, right? The only way you can calculate your potential risk to reward is to know where is your entry, where is your stop loss, and where is your take profit, right? If you have these 3 equations, you can define what is your potential risk to reward. But if you do not have this, target profit, there is no way to define what is your risk to reward ahead of time. So this is why I said not all strategies would rely on the risk to reward concept. Okay? So one such strategy is like trend following, right? We have no idea ahead of time, how much is the potential risk to reward on the trade. We have no idea whether it's going to be a winner, whether it's going to be a loser, or it's going to be a huge winner. No idea. The only thing we know is that we are going to enter at this price. We are going to have a stop loss of this at this level, and our position size is managed accordingly so that we don't lose more than a fraction of our account. Okay, so this is a second thing to point out, one of the myths, right? Not all strategies relies on this risk to reward concept. And the third thing, right, which I think is the most the question that you probably want to know is, how do you actually find the best risk to reward concept? Okay, so if you ask me, right, the best setups, right, are those where you know when you'll be wrong quickly, right? Or rather, you know where is the point where if price hits that level, you are wrong. So those setups, right, are those that lean against market structure as closely as possible. So let me explain. So let's see, right, this is a chart over here of Euro Canadian. Let me just basically plot my levels first, right, the support resistance. Okay, so let's say black one are, my support resistance level. Okay, so firstly, right, let's just make do with these two levels. So let's say, for instance, firstly, right, say at this point, right, let me zoom in. Okay, the market is over here. So there are some traders who will look at this, right? They know this is the area of resistance. They know this is the area of support. But they would, go short first because they have the fear of missing the move. So what they do is they quickly go short over here. They'll tell themselves, oh, there is this, high over here, which I, can use it to short this market. So they go short. And let's change this to green, right? This is the level they go short. And where do they put their stop loss? Well, this is an area of resistance, right? So let's say they know that their stop loss has to go above resistance. So let's say they put it somewhere here, right? Say somewhere here. This is red, all right? So from a risk to reward standpoint, all right, this is what they are risking. They're basically risking this much, right? This is their risk. And here to here, let's say they have a target of this, this area of support. So here to here is their potential reward, right? This is your risk to reward. Okay, not really a very favorable one, if you ask me. All right, so now what if a trader would be more patient and let the market come to a more favorable level, a level where they can they can have a tighter stop loss, right? Like say, for example, over here in this instance, right, let's say you go short as the market approaches this area of resistance, right? This time around your entry is much tighter, right? Let's say you go short somewhere here, right? Again, your stop loss is the same level because it is above the highs of this resistance. So right now you can see that from your risk to reward standpoint, it has greatly changed, right? This is now your potential reward. Okay, can you see the difference? Right, this right now, if you look at it, right, you are risking this much, right, this much to make potentially this much. Your risk to reward equation has changed, all because you are now being more patient and let the market come to a more favorable level. All right, now one thing that I want to share is that your win rate, okay, this is something that you have to track yourself, right? Because the rule of thumb is the more favorable risk to reward you're looking for, your win rate tends to drop. The least favorable your risk to reward is, your win rate tends to go up. But whether in the long run you will make money or not, you need to combine these two elements together and do the math, right? Otherwise known as what is the expectancy, right? But just for this today's AskRayner episode, just to answer this question, I just want to share with you, right? In my opinion, to get the best risk to reward trades is where you're entering off near the structure of the markets, right? Like support, resistance. If you're using trend line, near the trend line, right? If you're using moving average, near the moving average. Because, right, your stop loss can just go beyond it, right? And this is your risk, right? You can actually, have a larger position size and still keep your risk constant. Because, why? Because your stop loss is tighter, so you can put on a larger position size and still risk the same amount in terms of percentage term. Okay, so if you ask me, right, the best risk to reward setups are those that are near market structure. Those that are usually, let's say, in the middle of nowhere, in the middle of a range like here, not really, right? They are usually not the most ideal setup that you want to take. Okay, so let's do a recap, right? So, okay. So first thing first, right, your risk to reward and win rate goes hand in hand, right? You can't just look at risk to reward and not, look at your win rate, because as I've said earlier, risk to reward isn't the complete picture. You need both together, right, to know whether you'll make money in the long run. Second thing, right, not all strategies look at risk to reward. Like, for example, I talk about trend following. You can't define what is your potential risk to reward ahead of time because there is just no target. And lastly, right, the best setups, in my opinion, are those that leans near against market structure, right? Going long near the lows of support, shorting near the highs of resistance. Those, if you ask me, offers the best risk to reward, because your risk can be defined just by placing your stops beyond the market structure, right? In my opinion, right, the worst kind of setups to take are those that when price is trading in the middle of the range, or when it broke out, right, and is very far away from structure, right? Those are the kind of setups that I avoid altogether. All right, so in this episode of AskRayner, I hope this helps. I hope this answers your question, Mark, right? And if you've enjoyed this video, feel free to hit the subscribe button and the like button below. And if there's any comments, any feedback, just let me know and I'll do my best to answer them. With that, I wish you all good luck and good trading. Talk to you soon.